Hey everyone, I'm Cary Smith with Client First Capital. I'm sitting here with Amar Shah, and Amar and I are talking about target date funds. And if you have a 401k, a employer-sponsored 401k, an IRA, you've probably seen you might be invested in target date funds currently. And so what we thought we would do is just talk a little bit more, go a little bit deeper. What are some of the pros and what are some of the cons of target date funds? And then also maybe contrast that to having a portfolio professionally managed. So Amar, let's get started.
Yeah, let's get started. So the basic concept of a target date fund is that you have an allocation that's super aggressive, and then over time it becomes more and more conservative, meaning that the funds are more certain to be there when you need it on a certain date, right? So typically we see these target date funds in 5-year increments. So it'll be 2030, 2035, 2040, 2045, etc. And it's a really, like you said, simple way to kind of, decrease the amount of risk you're taking or increase the amount of certainty that you have that those funds will be there at a certain date.
Okay. And so as we look at this, Amar, what would you say are the major pros for having a target date fund?
Yeah. So I think like the first one you said, super simple, right?
Mm-hmm.
So we've already covered that. I think the second thing is that most of these target date funds, regardless uh, of kind of allocation, if you will, all right? Because a 2030 target date fund from Fidelity versus Vanguard, they're going to be different allocations. But on average, for the majority, they're typically a cost effective way to invest funds, meaning that uh, the internal funds, like if it's a Fidelity target date fund, they may not charge the mutual fund fees within the account, and they just charge one fee on the target date fund. So typically, you don't see layering of fees, and it's a cost effective way to kind of manage money.
Okay. So the cons, I mean, the pros are they're simple, right? You just need to know what's your target date for retirement and purchase the appropriate fund based upon that. And then they tend to be relatively low cost. And so those are some of the pros. Let's talk about some of the cons in my experience in life. Anytime that you're getting simplicity and low cost, you're typically giving something up. And so, what are some of the things that an investor might be giving up by using target date funds?
Yeah, so I got two here, and I'm going to say the first one is the user itself, in the sense that they may be picking the wrong target date year for them, right? So typically, when we see these, and I should stop and say, like the larger adoption of target date funds have been through retirement accounts, because through legislation, your employer can, based off your retirement age, have you start funding that target date fund, right? So that's how some people get introduced to target date funds, right? Now it's up to you to go in there and change it to change your allocation, but that's how most people get it. And oftentimes they're picking that the date that they retire, right? So if you're going to retire in 2040, you may have a 2040 target date fund, right? So you have a higher degree of certainty when you get there, the funds are available. But the reality is you may retire at age 60 and have another 20 to 30 years left on this planet. And so, being that conservative that early on may not be in your best interest. And moreover, you're missing out on a lot of growth that you may need to offset inflation for the back half of those 20 years.
So if I was going to retire in 2040, right, if that was my plan, and I do actually retire in 2040, it's like, well, then what? I've been, these last few years, I was super conservative, but I need this portfolio to fund my lifestyle, for another 20, 30, maybe 40 years, right?
Yeah.
And so I've always seen that as one of the downsides, because I've helped a lot of people move into retirement, as you have, and in a lot of times that's when their focus on their portfolio really maybe goes to a higher level, right? And it
Yeah, no,
definitely,
absolutely.
yeah.
Another con, and so the first one was the user picking the wrong target date, right? And then the
Mm-hmm.
second one is the actual target date fund. Because it's scaling down risk over a period of time, there is forced buying and selling within the target date fund within the prospectus, maybe quarterly, annually, but it's typically selling equities and buying bonds to scale down the risk, right?
Right.
And oftentimes, this is not taking the current environment into account, right? It's just forced. It's done. It's based off the prospectus. So oftentimes you could probably be in the wrong allocation for the current environment, for the current amount of risk that you want to take on, or you could be taking on more risk, right? There are periods of time where bonds are probably more riskier than equities, right? And so we want to make sure that we address kind of that transition part in a more managed fashion based off the current environment. And bonds have had volatility. We've seen it. If you made this rebalance trade, if you will, and there could be a 15% swing within bonds within 3 months. We've seen it with long duration bonds as interest rates have gone up. So it's definitely possible.
Okay, so there's definitely some pros with target date funds, but there's also some cons in those having those funds as your main source of investments. Let's transition real quick and talk a little bit about how that compares to having your portfolio professionally managed.
Yeah, I think the big thing here is that the portfolio is going to be tailored to your risk and hopefully to your financial plan, right? So in that, there's probably multiple different things that will benefit you. For example, you could have a pre-tax 401k, you could have after-tax 401k, and a Roth 401k. You probably want to own different things in different parts of those buckets. But also take the current environment into account, right? Like we just talked about earlier as one of the cons. Well, active manager, they're going to have some tilts in their portfolio to take account of the current risk in the environment, right? And then third, I would say that an actively managed fund on a risk-adjusted basis probably will perform, better, but on a total return basis, maybe about the same return, but you're not going to experience that roller coaster, right? And I think that keeps people on track and keeps them focused on their retirement goals.
And I would add, and we kind of covered this as a con, but when your portfolio is professionally managed, we're not just looking at the date you retire. We're looking beyond that, right? And so our vision tends to be longer, based upon not just your working career, but what do you want your retirement to look like?
Yeah, and that's part of the cost trade-off, right? Active management is probably going to cost a little bit more than a target date fund, but these are the other things that would be taken into account.
Yeah, very good. Well, I think we've, likely helped some people as they're, I know this is on a lot of people's minds. I know a lot of people are using them because it's typically often the default within their employer-sponsored 401k. So hopefully people found some value in this conversation. Anything you want to add to close us out?
No, I think we're good.
Okay. Well, if you have more questions or want to talk to someone about this, you can check us out at our website at clientfirstcap.com. Our contact information is there as well. And feel free to reach out to us. We'd love to talk to you. Thanks everyone.
Thank you for watching.